according to a recent Carbon Tracker report, too many investors are still flying blind, with many companies failing to adequately disclose information on the climate risks they face. Risks that we've all seen have intensified massively in recent weeks. To discuss this research and also how companies like Persefoni are working to make it easier for firms and financial institutions to meet stakeholder and regulatory climate disclosure requirements, we're delighted to be joined by Barbara Davidson, who is Head of Accounting, Audit and Disclosure at Carbon Tracker, and Ryan Miller, VP and General Manager for Private Capital Markets at Persefoni. To get started, Barbara, I believe you have a few slides which highlight some of those findings from your recent research. So over to you, and then we'll be talking to Persefoni also.
Indeed. Thank you very much. Thank you for inviting me to present today. It's a pleasure to be here. Quick intro on me, so you have some context to the reason I'm doing this work. I do have an accounting and audit background. I did previously head investor engagement at the International Accounting Standards Board, which writes the financial reporting standards for accounting financial statements. And before joining Carbon Tracker in November 2020, I got my master's in environmental policy and regulation at LSE. So that is the context from which I'm coming to you on my presentation. So if we go to the next slide, I'll talk about the work that was just referenced. And to give you some background first to the work that we're doing, there was some question in the past as to whether the accounting requirements and the audit requirements actually included consideration of climate-related risks in financial statements today. And as a result of this, in 2019-2020, the Global Accounting Standard Setter, the IFRS, or International Accounting Standards Board, as well as the U.S. Financial Accounting Standard Setter, the FASB for U.S. GAAP, clarified that the financial effects of material climate-related matters should be considered in the presentation of financial statements, in the preparation of financial statements. The International Auditing and Assurance Standards Board also clarified that auditors should consider these matters. And as a result of this, in late 2020, we had investor groups totaling actually over 110 trillion assets under management, writing letters emphasizing that they needed to understand how and whether management and auditors had considered these issues when preparing their financial statements. And they also went beyond this and asked for what they were calling sustainability assumptions, which is not required today. So if we go to the next slide, why is this relevant really quickly? Why is accounting relevant? Well, many items in financial statements today are valued using estimates of future cash flows, even though financial statements are here to tell us a story about the past. And when I talk about financial statements, I'm talking about the financial statements in the back of the annual report or the SEC document. I'm not talking about the other discussions like the management commentary or sustainability report. I'm talking about the financial statements. So because many items are valued using estimates of future cash flows, such as, for example, productive assets, they may be exposed to the risks of the energy transition because these assets could be used to manufacture products that are highly emissions intensive that may be phased out, such as internal combustion engines, or they could produce fossil fuels, as we know, such as oil and gas. And if management doesn't take into consideration the impacts of the energy transition, such as changes to demand, regulations that may reduce emissions or phase out their products, or disruptive technologies, they could be overvaluing these assets, so that if they're not thinking about the related declines in revenues or perhaps declines in commodity prices or increasing carbon prices. And so as a result, they could have overvalued assets, they could have undervalued liabilities, there could be overstated profits. All these issues can affect the company's ability to continue to use these assets, and this could affect their future revenue streams, future cash flows that they expect. This could lead to, again, as I said, overstated profits, undervalued assets, and as a result, investments or continuing investments in loss-making activities. And so also investors may not be able to effectively allocate capital if they're not aware of this, the effects on the company's financial statements. If we go to the next slide, as a result of all this, we did some work in 2020. We published a report called Flying Blind. We looked at 107 companies operating in the energy, industrials, and transportation sectors. So we looked to see if they explained that they did consider these issues when preparing their financial statements, and if the auditors did indicate consideration of these issues in their audit reports. And because of the background of these companies, we expected to see some evidence of this because we knew that climate and the energy transition was material to these companies. If we go to the next slide, the results of our analysis were very disappointing. So over 70% of these 107 companies provided no indication that they considered the effects of the energy transition or climate-related issues, including their own targets, when they prepared their financial statements. So again, this means they didn't indicate if they considered the effects of regulations on their estimated cash flows, changes in demand, changes in policies to use their products, disruptive technologies, and as a result, we did not know if their asset impairment testing included these considerations, if they, as a result, could have had accelerated obligations to retire assets, if they had overstated receivables, so understated credit losses, if inventory could be obsolete, if they were in contracts that could be out of the market, priced out of the market. We also looked to see if, to look at the assumptions, estimates they used, such as carbon prices or commodity prices, and only 25% even disclose that information. And we also looked to see if they provided a consistent climate narrative across their sustainability reporting and their financial statements. So if they talked about, for example, targets to reduce emissions by 2030, but they continued to use assets that had 30 or 40-year lives, how were these aligned? And what did this mean? Did this mean that they were greenwashing? Did this mean that they didn't have appropriate governance over these issues, or were these not included in their risk management systems? When we looked at audit reports, if we go to the next slide, we also had disappointing results. So if you look at the next slide, only 80% of the audit reports, and I'm not sure if my screen is frozen, but anyway, I'll keep talking. Only 80% of, over 80%, we're stuck on this slide, okay, there we go. The auditors had also, we saw disappointing findings when we looked at the audit reports. So we expected, when auditors provide their audit reports, they also include what they refer to as key or critical audit matters. And that means these are items that are for which significant judgments and estimates are required by either management or the auditors when they prepare the financial statements. And we would have expected, based on the nature of climate-related issues, for the auditors to have to also consider these issues as significant risks, especially for these companies, a significant risk of misstatement. And unfortunately, so things like impairment of assets would be a key or critical audit matter that many of these auditors included, and only 20% even showed indication of consideration of the financial effects of climate-related issues when they were auditing these items. We also saw some big differences between jurisdictions, between the US and the UK and the EU, which was interesting considering the requirements are not that significant. If we go to the next slide, my final slide, so you can see that we didn't see, the results were not satisfactory. I should say these were 2020 financial statements. And so we are now going to start looking at 2021. So hopefully we'll see an improvement. We're also working on what we call an alignment assessment for the Climate Action 100 Plus as part of their benchmark, their net zero company benchmark. And actually the results of that will be coming out tomorrow. But that was also for 2020 companies, and that had more stringent scoring versus the flying blind report we did. So the results are even less satisfactory. But moving forward, we'll continue to engage with companies and regulators and investors, but everyone has a role to play here. I mean, companies need to ensure that they increase consideration and transparency of these issues in their financial reporting, improve their governance and oversight of these issues, make sure their audit committees discuss this with their auditors. Auditors need to provide better transparency over these issues. Regulators need to start, they are doing a better job of identifying this in company financial statements and auditor work. And investors need to make their requirements clear to companies when they engage and we're seeing this more now in voting. So that's a quick run through of the results and the work that we did.
Excellent. Thank you so much, Barbara, for that. You mentioned this is 2020. I mean, do you have any optimism that last year things are moving forward, that it will be better when you repeat the process? I mean, obviously we saw COP26 last year. We saw more focus than ever before. We saw, the Glasgow Financial Alliance that we were talking about earlier today. I mean, any good news there that maybe this gap is starting to at least move in the right direction? We
are seeing some improvements for some companies. Yes, we are. But I will say for some of the American companies that we looked at last year that didn't talk much in the financial statements, we've so far seen pretty similar information in their financial reporting, unfortunately.
Worrying stuff indeed. Ryan, I can see you're nodding along there. I mean, first up, for those who don't know, who are Persefoni and your involvement in this space? And then secondly, does Barbara's analysis and Carbon Tracker's survey ring true with what you're seeing in the market also?
Yeah, thank you. So first, Persefoni is a software platform that enables organizations, both operating companies, but also investors, to properly account for carbon emissions across their operations or their investments. And at Persefoni, I lead our private markets business. So I engage with our private equity customers, their portfolio companies, private credit, banks, insurance companies, all along the spectrum of financial services. And so in that role, I get a lot of insight into both what Barbara is saying around what investors are looking for from companies, but also what companies are doing to try to fulfill those investor obligations. And I think what Barbara shared does ring true. I mean, there's a pretty consistent gap between what investors are looking for in terms of climate and carbon-related transparency and forward-looking understanding of risks and what companies are actually producing in the market today. And now I think you can trace that back to the lack of consistent tools, systems, software products, knowledge, personnel to be able to get there. I mean, if we make the comparison between financial accounting and carbon accounting, it's like we were asking companies that are publicly reported to be making consistent disclosures about their projected financials, but we were assuming that they were doing that base accounting in books, in physical books, like the way that they used to. And that's the way that a lot of carbon accounting and climate accounting still happens today. And so we're at this really interesting moment where there needs to be this massive ramp in everything from the core systems that account for carbon, the core systems that account for physical risk, and then the knowledge and personnel and systems that enable that to be translated into the forward-looking statements around risk to enable better transparency in what Barbara and the investors that she speaks with are looking for.
That's really interesting. So your argument would be that this isn't so much an awareness piece anymore. You know, it's been 6 years since Paris. You know, a company that, particularly large companies that aren't aware of this agenda, you know, have been completely burying their head in the sand. They're not there anymore. They're aware of what they need to do. It's more, you'd argue that they often lack the technical skills and the tools to actually do this disclosure well. Is that's your hypothesis, if I'm getting it right?
It is. I mean, I want to be candid and say that if we asked companies, do you believe that your climate accounting is as important as your financial accounting? 100% of companies would say no today. And I think if we're actually going to make progress against the climate change crisis, that number will need to increase. And organizations will need to start thinking about their climate accounting on par with their financial accounting, not as a subsidiary to it. But I do agree, though, that even for those companies that are on that journey and they have the awareness that's needed in the time post-Paris, there's still a massive gap in the ability to turn that into action.
Yeah, no, interesting stuff. Barbara, what's your take on that? I mean, do you think that the awareness is now there and it is more of a technical challenge, or do you still think there's some companies that are just, even though, as I say, it's been 6 years, we've been banging the drum for a long time, Carbon Tracker's been going for over a decade, there are still the arguments not cutting through with, that this is important?
I think the importance is there. I think there is maybe a lack of understanding or awareness for some companies as to how to consider these issues in their financial statements, because there is still a concern or a perception that we're asking for new information, for a new input, a new discount rate, and we're actually not. We're saying the information, the inputs you're using today, have you considered the effects of climate-related issues? Now, and because financial statements are historical, so more or less, there is still a perception that they don't have to, management doesn't always think about these issues. Well, actually, they are going to affect my future cash flows. That is I think for a lot of companies, that's the situation. I mean, there's awareness of the energy transition and climate-related concerns, but not necessarily how it translates into the financial statements. But there are also some that we're seeing that are saying, well, management is just saying we don't think we're going to achieve the energy transition in the way that investors are asking us to portray it, and so we're not going to input those assumptions and estimates in that fashion because that's not what we believe. Some big companies are doing that.
So again, a worrying and sobering trend.
Yes.
Ryan, come to you here. I mean, what do you think needs to be done to start tackling this disclosure gap? I mean, as you say, there are companies like that Barbara mentioned, but for many, they're aware of what needs to happen. They're certainly aware that regulation is coming and there are standards now available to them. What are the barriers you think they need to overcome to improve their climate disclosure performance?
Yeah, I mean, it's a great question. When you look at the 20-year history of the greenhouse gas protocol, It hasn't changed much. I mean, obviously it's continued to be built on, and there's increasing guidance around how to account for carbon in a company's operations. But what's been interesting is over that, the majority of that 20 years, every disclosure around carbon has been voluntary in nature. And that is changing, right? I mean, if you look at countries around the world where the largest financial systems are starting to regulate climate disclosures, and the SEC is obviously the most recent to propose a climate-related disclosure. I think that will change the way companies start to think about the core climate-related disclosures that they make. It's no longer something that's voluntary and aligned to an ESG or a corporate social responsibility program. It's now something that's integrated into the office of the CFO. It's integrated into your disclosure statements, your compliance statements, your forward-looking accounting. And so I think there will be an interesting moment over the next year, especially as the SEC proposed rules start to land with companies, where the center of responsibility for managing this will change. And I think that will be an important moment in making this part of the everyday process for companies. Now, that being said, I still think that there's a massive ramping that's needed in the tools and systems in place, even at Fortune 500 companies, to manage this better on an ongoing basis. So that's some of the work that we and others in the industry are trying to improve.
And do companies have the data? I mean, that's one of the other issues that's come up from a couple of the discussions today, particularly when you start to get into scope 3 and you're going down into supply chains and value chains. You can have all the tools in the world, but if you haven't got the decent data, you've got a problem. I mean, is that still a challenge here also?
Yes and no. I mean, obviously, scope 3 will continue to be the challenge that's worked on for decades, right? Is trying to get better information from suppliers and other organizations in the value chain so that you can perfectly account for carbon within your company's operations. But perfect doesn't have to be the enemy of good. And there are options within the greenhouse gas protocol for estimating scope 3 emissions in the absence of having perfect data. And so any company that says, well, I can't manage my scope 3 because I don't have my suppliers reporting to me, that to me is just pushing off the issue. Start somewhere. Start by estimating your scope 3 emissions based on spend, something that you certainly know. Then move to estimating your scope 3 emissions based on quantity of purchase volumes or distance traveled in shipping. And then over time, move towards complete and clear disclosure from your suppliers that can feed into your carbon accounting. But that has to be a journey there that companies go on. And I think saying, well, it's too challenging, putting my hands up in the air, I can't do it, is not going to be an answer anymore.
Absolutely. Barbara, what do you think is going to happen to those companies that are underperforming on disclosure? I mean, the carbon tracker hypothesis for a long time has been that ultimately they will suffer, that they will be, worse across managing their risks. They won't see the opportunities that are out there from this transition. I mean, are you starting to see evidence that that is happening and that the companies that do this well, reap the benefits?
Well, we can certainly see from the investor standpoint that is happening. There's a lot more investor pressure on companies now to disclose the information, and that way at least investors can engage with those companies to transition. So, we saw last year with Exxon Engine 1, the board members that were replaced. We're seeing more resolutions being filed by investors asking for more information, and they're not backing down, and they're getting more and more votes towards these. So I can say that investor pressures will certainly increase. And yes, I mean, companies are already, a lot of these fossil fuel companies are not doing, okay, fine, we're seeing some blips right now because of geopolitics, but generally speaking, disruptive technology is less expensive. It's clearly, cleaner and more preferable. And so, yes, in the long run, these companies, even the lowest cost ones that are out there to try to survive, are not going to do so well.
Yeah, absolutely. And Ryan, I mean, same question, I suppose, for you and your clients. I mean, presumably, obviously, these kind of tools and reporting, you can pitch them as a compliance play, particularly as those regulations are coming through. But the argument's also been that they help unlock quite significant business benefits. They help optimize an organization. Again, are you seeing that with the clients that you're working with?
Yeah, absolutely. I mean, I think there's a range of benefits that can come from having better management of carbon emissions, better management of climate change generally. I mean, everything from reduced cost of capital, cost savings across an organization, having preferred relationships with enterprise customers who are purchasing on this basis, having a more favorable enterprise value in the market because you're being recognized as a leader in this space. I think there's a range of benefits. And I think the engine number 1 and Exxon example is a really interesting one, Barbara, because why was it so well covered? It was so well covered because it was rare, right? It was the first time that something like this had happened. And so, someone once gave me advice about if you're scared about something happening to you like a shark attack, you shouldn't be scared of that. If it is rare enough to be in the news, it's rare enough that it probably won't happen to you. And I think that's true with climate change as well, is that what we're seeing this year versus last year. Last year, there was this one incident, the Exxon directors changed, which was so rare, it was all over the news. This year, what's happening? Lots of little changes in cost of capital and sustainably linked finance and preferred relationships with customers becoming so common, it's not newsworthy. That's actually really positive for the climate change transition generally, is when these things start to become common in everyday business operations.
That's fascinating. Well, I love that way of putting it. So we need proxy votes that are not like shark attacks. They're like a sort of constant drip away at these companies to get them to change their votes. Barbara, I see you smiling. Would you agree with that? Is that this needs to become commonplace? This can't be these one-off hits.
Oh, absolutely. I think it is going to become commonplace. And also, just to add to the cost of capital comment, I mean, we're seeing a lot of the financing of emissions, the disclosures of what the financial institutions have to show as what they've financed as emissions. And so we're even going to see, a lack of financing for these companies as this continues.
Yeah, no, it's a big trend that I think is coming very, very quickly. We've got an interesting question here from Dave Gorman that I'll put to both of you. He says he wonders whether or how we get to the point where companies deal with sustainability issues and coming sustainability issues like oceans, biodiversity, chemicals, that look beyond climate change hopefully before. I mean, they're already at crisis point. But it's an interesting point. The carbon tracker is obviously by definition focused on carbon. A lot of the focus on climate disclosures all around climate. But there's these interlocking other issues that similarly pose big risks to businesses and finance, and yet massively underreported. Barbara, I know Carbon Tracker has a sister think tank, Planet Tracker. I mean, do you think we're going to start to see more focus on that? And what can we do to ensure that we get it, that businesses are aware of these wider risks?
Businesses should certainly speak to investors about their concerns. But in general, yes, we're going to see, as part of climate change, we'll see more discussion around the just transition. And there is still, we talk about ESG, there's the S and the G, although the G covers the environment as well. The International Sustainability Standards Board that was formed last year is starting on climate, but it'll start looking at other issues in the disclosure space. And so the more that comes into play and the more that comes into play with regulators, the more aware companies will be. But investors need to talk to the companies about these issues today.
Absolutely. And Ryan, is this something that Persefoni is looking at, that there are these related fields that in many ways, I suppose, are harder to quantify? Quantifying biodiversity, as we discussed earlier today, that's a tricky challenge, but presumably something that you need to start to get your teeth into.
Yeah, I agree. And we are looking at it. I mean, there are incredible parallels between the worlds of climate change generally and carbon emissions, and then what you think about in nature and nature-related challenges and biodiversity, both very hard to account for. With climate change and carbon emissions, again, we have this 20-year track record of the greenhouse gas protocol. We don't have that same construct on the nature side. We have, 5 to 10 years of TCFD and TCFD aligned disclosures, even as that's becoming obviously much more common. We don't have that on the nature side, but we're getting there with the Task Force for Nature-related Financial Disclosures. And so I think the ramp in awareness from the company level, the investor level in climate change that you've seen over the last 5 years, I think you'll start to see that on the nature side as well. And I think it's another one of those challenges that will require really advanced tools, systems, processes, knowledge, people internally that can manage it.
Let me see. I just want to, before we wrap up, I want to go back to a story you mentioned, Ryan, the SEC coming out with its consultation on new rules. And obviously the EU already doing something similar. The UK, as Lord Callanan mentioned this morning, has its sort of much more robust net zero transition plans coming through. Barbara, do you think businesses are sufficiently prepared for, businesses and investors, for the level and the robustness of some of these regulations and rules that are pretty imminent now, coming into force?
Well, the SEC had two pieces to that proposal. So one would be outside the financial statements in the scope, 1, 2, and 3 emissions. And as Ryan had mentioned, they're learning how to estimate those. It's a process. We all know it's a learning process. But for the financial reporting, which is already required today, I think that they have the information available. I mean, they are still learning. They need to integrate that into their financial reporting systems, fair enough. But I do think that they have the tools that they need for the financial reporting piece, or they can at least get that information with engagement and also discussions with their advisors. On the outside of the financial statement piece, I think it's a learning process. So may not have all the tools today, but they'll have. But TCFD, look, that's been out for how many years now? 5 years. So I think that there are certainly many mechanisms that companies can use to try to understand how to integrate this information.
Yeah, Ryan, and do you think your clients and the wider community are aware enough of this? Because it strikes that if it's done right, these moves are big deals.
Yep. No, I don't think they are generally, and I think that when you look at the SEC's rulemaking process, Persefoni was heavily engaged with the SEC around, could companies get there? Like, are the tools in place today to allow companies over the next 2 years to prepare for the first disclosures that will be required in 2025, 2024, and 2025? And I think the answer is yes, that the tools are there, that it won't be so costly or so burdensome that companies can't get there. But I think when you look across the majority of public companies today that would be impacted by the SEC's rules, no, they're not ready. But it's not a time to panic. It's not a time to pursue a take private transaction because you don't want to be subject to these reporting obligations. It's just time to start working on it. Yeah. And like any other matter from a compliance perspective, from an accounting perspective, with the right tools, with the right time, with the right resources, it can be done. And I think we'll see a big change over the next 2 years and companies getting ready for that deadline.
That's an interesting way.
Sorry,
Barbara, go on.
Sorry. I wanted to just add that the reporting shouldn't be driving behavior. So we're hopefully companies have already been talking about these issues internally for a while, and that there has to be a strategy to transition those that are carbon intensive, and their emissions need to be reduced. So I'm hoping that maybe they don't have the tools exactly to report the way they need to, but hopefully management has been discussing this at some level, even if there are silos within the companies. And so, hopefully they can gather the information that they're already starting to try to do.
Do you think it will be properly enforced? I mean, that's one of the potential risks here. That we've arguably had similar rules in terms of directors having to report on material risks for decades, and those rules, you could argue, have been openly flouted with companies not reporting, as Barbara made clear with that report. I mean, is there a slight risk that these regulations come in? They come in Brussels, they come in London, they come in New York. Will they be enforced? Will we see companies made to deliver on these new guidelines, this new legislation?
Well, I would say if I could predict enforcement regimes, I would probably have a different job. But I think one of the things that is quite different about this round of rulemaking versus previous attempts is that it's a lot less qualitative, and there are some pretty significant quantitative components. And when you start introducing quantitative components that need clear and consistent disclosure, it is much easier to enforce from a regulatory perspective than purely qualitative, materiality-driven, board of director best judgment-driven disclosure. And so I think it will be a different era.
That's really interesting. So you couldn't have somebody just stick a sentence on and say that's my material risk disclosure and then argue about it. It's here are the numbers, you've got to show them to me.
Yep.
We've literally just got a few seconds left. I'm just going to ask you both a sort of quick one-liner answer to finish off. Barbara, if you're talking now to a company that's in that majority of businesses that aren't doing this properly, what's your pitch to them? What's your message to say, hang on, you need to get with the program here. You're taking a risk. I mean, what's your one-liner to try and win them over and get them on the right side of this argument?
Well, increase your governance, but speak to investors about this so that they understand what you're doing, because otherwise they're going to start trying to replace you.
Indeed, that's a stark warning, Ryan. Same question to you. What's your 1 minute, your one sentence pitch for companies that are maybe wavering on this currently?
This is the new normal, and the tools are out there to do it. You just need to get started.
Indeed. And as we've seen today, the companies that are getting started and doing it well are finding that it's not that onerous and it delivers massive benefits. So, the opportunities are there. Thank you so much for that really enlightening session from Barbara Davidson at Carbon Tracker and Ryan Miller at Persefoni. And also a huge thank you to Persefoni and our other sponsors today for supporting this event. As I said, we couldn't do it without you. So thanks so much all. And we will speak soon.